started, I know most of you, my name is Meredith White. I am David's office manager, marketing director, whatever he wants me to do that day person. So thank you guys for coming. I know it's really cold outside, and we also are braving something going around with COVID. And so we do appreciate you being here. And I know that the information that's going to be presented is going to be very well worth your time. And we'll be taking questions at the end of each presenter. So we are having two presenters today. Of course, David Guttery, president of Keystone Financial Group. He will be talking about the economy. It will be some of the information that some of you have already heard in some of your meetings, but it will be also more in-depth information that you may not have heard in up-to-date information. And then we also are going to have Monica Quinn, who is a tax attorney with Massey, Stotzer & Nichols, and she's here with us as part of our resource group, and we really appreciate you being here, Monica. And she's going to give us an update on what's happening in the tax world and talk to us about how any potential changes could affect us as individuals and businesses. Again, we are recording this event, and so just keep that in mind. And then once we have a lot of the clients that did want to attend but could not for one reason or another, and so that's when we decided, well, let's just video it, and that way we can send a link out, and everybody can take advantage of this opportunity. So I guess that's it. So I guess I will now present to you David Guttery.
Thank you. Meredith is modest, make no mistake about it. She is the oil that runs my office and my indispensable right hand. Thank you very much. As she said, what we're going to cover in my part, I'll try to make this brief, but as you know, I can be verbose. But it's good information, and really just since last Friday, we've had a slew of information that has been updated, and every time there is another piece of data that changes. It's another pixel in the picture, and when the picture changes, it has an influence on what we offer to you as advice and what we should do proactively to get ahead of what we think is coming. We'll skip through the disclosures. For compliance, we spent 5 minutes on the disclosure page. Y'all know me, the founder of Keystone Financial Group. We are a fee-based wealth advisory financial planning firm, which means we're not agnostic. We're agnostic when it comes to platforms and products. We are about the planning first and foremost. That's what tells us what we need to use to implement the platform to make the objective come to reality. And that's what we're really going to talk about tonight. What guides us day in, day out, month, quarter, year in, year out to help y'all achieve the goals that we've laid out in our plans. So every one of you that have had a quarterly review with me have seen this image before, and you know what I'm about to say. If I could give you a graphic that describes the market, in fact, not all of the market, but half of the market right now, it would be this. There is a part of the market right now that is overly valued, and I mean by historical margin. And the market has yet to reprice for risk, and that's what it does, right? The market always reprices risk, but it hasn't yet, but that doesn't mean it won't. So what will be the catalyst? Could it be another report of higher than expected inflation at the producer level, at the individual level, your income not keeping up with that inflation, with consumerism being lower than we thought it would be? Think in terms of darts. Is that Iran backing away from the nuclear agreement? Is that the 100,000 troops on the border with Russia, on the border of Ukraine? Is it China? Is it North Korea firing ballistic missiles from the backs of submarines? There's a lot going on in the world. And what I do when I'm working with all of our clients is we understand what's happening in the world, and we ask what if this happens next to determine what we advise next in our portfolios. You've all seen this graphic before. Think of the changing economic cycles in terms of seasons. Now I'll give you a little background on this. Clearly I'm not the author of this graph. I saw this for the first time 35 years ago as a freshman at the University of Alabama in my first Econ 101 class. And I knew on the first day of that class that I was going to major in economics. Wound up double majoring in finance and economics, but you couldn't get away with this today. But think of Kramer from Seinfeld, that was my Econ 101 professor. And he burst into class. Before saying a word, he drew the supply and demand curve on the blackboard, and he said, if that's not the sexiest thing you've ever seen in your life, get out of this class. I knew I was going to love economics at that point. Economics, to me, explains what's happening in the market when the market seems to be acting irrationally. So think of this in terms of seasons and how your behavior is incentivized by what you feel. We go from spring to summer to fall to winter and then back to spring again. When it's warm in July, you're likely wearing short sleeves, shorts, and you're out on a boat somewhere. Seeing as how none of you are wearing short sleeves, I would assume that means it's cold outside, and it is. Your behavior is incentivized by what you feel. There's always something to wear, but what you're wearing is influenced by what you feel. We're in here beside a fire. There is something, though, to be in, an exposure to be had based on where we are in the economic cycle. So when wages are rising, taxes are lower, inflation is lower, you typically feel more confident, therefore velocity of money is higher. Why? Because you're out there spending money. So discretionary spending. You typically consume more of that $7 cup of designer coffee. Industrials do well, transportation does well, technology does well. But a funny thing happens as you move down the economic cycle. Income doesn't keep up with inflation. You have less discretionary income. Taxes could potentially go up, Monica. You begin to become increasingly judicious about not only what you buy, but where you get it. And that's especially true if there is a disproportion between what you have to have, the economically inelastic things, like gas and food, and overall headline inflation. So you consume fewer glasses of that discretionary cup of coffee, but you don't stop buying toilet paper, which is why staples and utilities and healthcare and pharmaceuticals and energy typically do well in a declining economic environment. You've all seen this ad nauseum. You know we've talked about this all year, and it's materializing now as we speak. This was on my dry erase board. We've added a few things to it. This is a very headline overview of some of the risks that are involved in the market. Right now, you could draw subgenres under all of these. And in fact, I could draw another one right there and put current market valuations. Whether it's geopolitical concerns, whether it's market concerns, whether it's inflation, income, taxes, political concerns. And I'm not going to make this conversation about political issues, but you have to observe where we are. This Congress seems bent on promulgating the next spending bill, but there's a problem. The Federal Reserve announced in November that we might start to think about tapering. And by the end of December, they said, y'all ain't seen nothing yet. They are aggressively accelerating their tapering schedule, and furthermore, last week, Dallas Bank President Bullard suggested that we could get the first rate hike by the end of March. That's a big departure from where we were in just in November. So as the Congress spends, the Fed is no longer the largest single central purchaser of treasuries because they're not printing as many dollars anymore, so now that's a headwind. And we're going to have that headwind for at least the next 10 months. China. You have to ask, at near now, an all-time record high in the market, what would happen if China were to devolve into a point of crisis? What if they invaded Taiwan? Which, by the way, Taiwan is the largest supplier of semiconductors to the world, in case you didn't know that. Guess what we're short of right now? How might the market respond and reprice for that risk? How does the U.S. respond militarily? How does the world respond from nearly an all-time record market high? North Korea is firing ballistic missiles now from the backs of submarines. I guess they could float those things wherever they wanted to now. What if they accidentally or intentionally shot the wrong missile at the wrong country that happened to be one of our allies? How do we respond to that? How does the market reprice that risk if it were to happen? Russia, what did we hear today? As we speak, Secretary of State Blinken is overseas in Ukraine talking with officials trying to de-escalate a situation. Meanwhile, Ukraine said today if one Russian boot crosses the border, they will consider that an invasion. They are surrounded by our NATO partners. What happens? From an all-time record high, If that devolves into a crisis, how does that implicate us? How do we respond? How do our NATO partners respond? How does the market reprice for that risk? Iran. Now they're suggesting, or Iran is saying, that they won't come back to the table until we guarantee that we'll never leave the table again, plus other demands. That is a contentious conversation right now. Boy, there's a lot going on in the world. At a time when the market is seemingly having difficulty establishing new highs. And if today is any indication, by noon we were up 450 points. By 2:30 we were down 450 points. That was a 900-point swing in a 2-hour period of time. That's not a good sign. So yes, the market is nervous. Yes, the market seems to be willing to reprice risk at a time when there's a lot going on in the world, and we haven't even talked about COVID yet. We know about 3 variants. I have heard about there being a couple of obscure other variants. But every time we have one, over Christmas, we had record pre-pandemic, better than pre-pandemic levels, demand for travel on the day before Christmas, but we couldn't fulfill that because the crews were sidelined and with COVID, with the new Omicron variant. So every time we hear of a new variant, it affects the economy in some way, right? And we're afraid that it's going to shut us down again. And we have overseas implications. How many more variants are we going to have to deal with? We're hearing mixed messages from the administration in terms of vaccination. Is it effective? Is it not effective? I have heard Omicron referred to as Mother Nature's vaccine. Does that incentivize people to not get the vaccination? We don't know. But every time there's another variant, it seems to implicate the economy, and thus the market notices. So, oil. Talking about economically inelastic things. How many of you in here drive an electric car? So you all consume gasoline. It is something with which we cannot live without. Oil is obviously the source of gasoline. We drive cars, we go to work, we take children to school, we go to the store. The food that you just bought at Publix today spent some time on a truck that was not an electric vehicle. So as oil continues to climb, so does gasoline. It's economically inelastic. You must have it. Now, this was an article from about 2 months ago where J.P. Morgan laid out a path for $200 oil, and they weren't being facetious. It can happen. How? This administration, like previous administrations, has not been friendly to fossil fuels. Tighter EPA regulations, and among other things, a higher carbon tax footprint, or tax if you are a fossil fuel producer, has disincentivized American production. We can quantify that in any number of ways. The Baker Hughes North American Rig Count Index is down over the last year. The volume through the Cushing, Oklahoma transfer facility is sharply down over the last 12 months. But demand didn't go anywhere. So what do? When supply doesn't meet demand, you have to import the difference, right? Quietly, Russia has become the second largest source of our imported oil, second only to Canada. That's bad because right now Secretary of State Blinken is trying to negotiate with those same Russians to not invade Ukraine. So what if the supplier of our second largest supplier of oil that we need is suddenly our adversary in a global conflict? How might the market reprice for that risk? So supply and demand obviously is bad enough. The Fed is continuing to print money. They're just tapering. That means they're printing dollars at a slower rate. But with every dollar they print, the rest of them become weaker. Oil is denominated in dollars. So as long as we have global demand rising and supply static or declining, with a commodity denominated in dollars, none of that is a good indicator for the price of oil declining anytime soon. So clearly that's not good for gasoline either. Here's an example, just one, of how U.S. production has curtailed. Los Angeles County is completely out of the fossil fuel production grid right now. Don't know if that's permanent or not, but there once were 8,300 producing rigs in Los Angeles County alone. In a given year, they account for 18 million barrels of oil per year. Guess how many barrels of oil we consume per day in the United States? 18 million. So one county is responsible for one full day's oil consumption in the United States, and they are off the grid. And that's just one example. Shortly after the J.P. Morgan article, Bank of America came out with this article within which they suggested gasoline prices could double. Think about how that would proliferate to every aspect of your life. The clothes that you're wearing that you bought at Belk were trucked there. Trucks use fuel. The price of that goes up. Your prescriptions go up. Your groceries go up. The cost of the gasoline that you put in your car goes up. Now, there's a pelican brief to be made here. I don't know how much of this is conspiracy theory, how much of it is the truth. However, this administration, unlike others, seems to be very interested in pushing an EV and ESG policy, incentivizing, encouraging automotive companies to accelerate targets from 2040 to 2025. And that's all well and good, but I don't think they'll get there. And you could Google this on your own. If every driving household in America had one electric vehicle, it would collapse the power grid. We don't have the infrastructure to support that, yet that seems to be a primary agenda item of this administration. I wonder, you have to ask, could the administration be using higher fuel to incentivize you to think about driving alternative means? Don't know, but we seem to be running out of lithium too. We don't have enough rare earth minerals to meet the demand for the rechargeable batteries either. So there's a no-win situation here, but in the meantime, gasoline continues to go up, and that which supports that higher price is not abating. You have to have it, so the higher it goes, the more you have to spend from your finite capacity to spend, which leaves you infinitely less to spend in other places. We have to be mindful of that. This is straight from the St. Louis Reserve Bank of the Federal Reserve, the Fred graphs, and it shows clearly that gasoline is up 50% from where it was from December to December. Food prices. Obviously, your food spent some time on a truck. That truck was powered by the same gasoline that's up 50%, so it's no wonder that food generally, nebulously, is up 38% over the same period of time. Now, in this article that appeared on CBS News on October the 6th, the CEO of Kraft Heinz was quoted as saying, in their view, they see families that are struggling with the week-to-week decision to refill prescriptions or buy cheese being a metaphor for basic food staple items. If we are truly in an economy where there are an increasing number of families that are struggling with the decision whether or not to fill a prescription or to buy food, tell me you're going to be more inclined to buy the next iGadget when it comes out. If a greater and greater percentage of your income is you're forced to spend it on the things that you must have, you're left with increasingly less money to buy the things that you would like to have. The utility of spending, you focus more on what you have to have and less on what you don't have to have. And that's the environment that we're in. Make no mistake about it, we are not in a consumption economy. But yet the market hasn't blinked. Now, you can melt up as well as melt down. And I think that we've seen in the fourth quarter especially a melt up for reasons that could not be justified on a spreadsheet. Inflation was a big part of that. This was fresh data we got last Friday, the PPI. I had a pen up here. Inflation at the wholesale level, the producer level, was up 9.7% from December to December. Prior to, in November, it was up 9.8%. That was a fourth straight rolling one-year all-time record high. We've never seen inflation this high before at the wholesale level. So said another way, what did it cost the company to make this clicker? That went up 9.7% 30 days before you bought it at Walmart or your favorite store. Yes, the forces that are behind this are partly attributable to supply chain disruption. Look, when you turn your economy off and then turn it back on, the containers that move products across the ocean are on the wrong docks. We typically don't send empty containers back across the ocean to be refilled with the things that we just bought. That adds to the cost. Part of that's happening right now. I would contend to you that the Federal Reserve is actually responsible for a much larger part of the inflation that you ultimately see when you go to the store, and that's the CPI. That increased 7% from December to December. So I can tell you this, I monitor 10 what are known as leading economic indicators. These graphs, that is just a snapshot of where the leading economic indicators were 30 days ago. So knowing where the leading economic indicators are, I can almost guarantee you, I'm not sure, I might be wrong, but I'm pretty certain that next month's January to January PPI is going to be higher than what we saw in December. And because of what I see in December, I'm reasonably sure that what you're going to feel at the store is going to continue to go up. This is not abating. And just last month, Fed President or Chairman Jerome Powell said, let's just stop using the word transitory because this is not short term. This is systemic. We've been saying that now for several quarters. But in the media, what are we hearing? Household income. It's way up. This is a good sign. This is a sign of a strong economy that we have this inflation and we can afford it. Can we? This is from the Economic Policy Institute, and these statistics were sourced from the Bureau of Labor and Statistics. Now this graphic is old. This was from November. From November to November, all non-farm employees' wages rose by 4.9%. There's a difference between income and wages. Income contains a lot of noise. We'll talk about what that noise is in just a minute, but noise is the child tax credit. It is the pandemic unemployment assistance compensation and all kinds of other things that were promulgated under the CARES Act that might not be here much longer. 4.9% is the rate by which your ability to consume rose. And after you paid tax on that, let's say that you kept 4.3 of it. By the way, in December, that number was 4.865, so not much off of this November graph. So I just showed you a graphic where headline inflation was 7, your ability to consume was 4.3. There's a negative disparity there, right? In our ability to consume things. GDP is 70% consumption. Our consumption's going backwards, yet the market hasn't blinked. Now you can't stop there with the wholesale, with the headline number. And we just talked about gas or fuel and food. Fuel is up 50%. Food's up in the mid-30s. You got to consume that first. So it's taking a much larger chunk out of your disposal, out of your income than it previously did. That leaves you a lot less to go spend somewhere else. And when you get to that favorite store, you're finding that your capacity to buy those things is down 3% from where it was just last year. And this too came from the Federal Reserve. But wages are rising. No, they're not. They're actually declining. And this was current. It's hard to see that. I ran that out through the end of the third quarter. But the trend is declining wages. Why would we see a trend of declining wages? Think about what happens if you're the company that makes this thing and you're not buying as many of them anymore. Tell me you're going to invest into the things that make the capacity larger to make more of what you're not buying. It doesn't work that way. Companies now are doing 3 things. Hoarding cash. We see that now for 9 straight months. Cash on hand, U.S. corporate balance sheets is rising. Well, if it's rising, if you're saving money, you're not spending it. What are you spending it on? Process automation, technology, and information management. Why? To employ people remotely, because that's a cost savings, and to find things that make your production more efficient, to make fewer of these things with the same profit margin. Tell me you think that includes rising wages. It doesn't. So here's where the media throws this graphic out. Look at income. It was up 12% year over year. Well, I just showed you a graphic from the Bureau of Labor and Statistics that proves that wages were up 4.9. This is 12. What's the difference? All the noise that's about to cipher out of this equation. Like the child tax credit. This did not make the news. I saw this graphic on Monday. Last week, Congress failed to extend the child tax credit. And given the amount of gridlock that I think that, who knows, Kristen Sinema, Joe Manchin, some other vulnerable members of moderates, maybe of the Democrat Party from otherwise red states that might push back and not vote in lockstep, who knows? I wonder how difficult it's going to be to continue to promulgate an extension of income benefits that came from the CARES Act. That's the difference between wages and income. It's declining. Now remember me telling you in that graphic before about the seasons, about how you will behave as you're incentivized? This is retail sales. Now this is odd. In November, we saw that curious little bump right there. And I thought that's a Christmas season bump, and it was. But I wondered if it would continue. And I've read a basket of economists that suggested it might, but we expect that it would likely continue this downward trend. Are retail sales strong? Relative to time, Look at all of that income that was given to us under the CARES Act. We all didn't get it, by the way. Extended unemployment benefits, you're not going to find many engineers, many lawyers, many teachers, many doctors, many financial planners that actually benefited from that. There is a concentration, mainly in the hospitality and leisure section, that got most of that. Still, I digress. Our consumption has sharply declined, though. 11 out of the last 12 months have been negative. And sure enough, in December, so much for that Christmas rally, it was down. The market was expecting a gain of like 1.5%. It got a decline of 1%. That was big. Big departure from expectation, and the market did not blink. So I'm actually going to go back to this graphic. I want you to get that image burned into your brain and look at retail sales. Look familiar? That's proof. You will behave. Your patterns of consumption are incentivized by how you feel. Clearly, we feel cooler. Our incomes are not keeping up with inflation. That which we need is taking much more of our spendable income away from us, leaving less to spend in other places. Retail sales are declining sharply, yet the market hasn't adjusted to that risk yet. Goldman Sachs, Bank of America, JP Morgan, name your company. They have all come out with cuts to their GDP forecasts. This was from the last quarter. Toward the end of the year, Goldman cuts their forecast for both 21 and 22 from what had been 6.6% midsummer to 3.25 by the end of the year. A 50% reduction in forecast for GDP for 2021. The market did not blink. And then they cut their forecast for 2022. And then they cut it again. Now we're down to from 4.8 to 4.2 to 3.8. That's a 25% reduction from what we'd originally estimated in terms of 2022, yet the market did not blink. So I'm going to use Apple as a poster child. I'm not in favor of Apple. I'm not against Apple. I own Apple to a smaller extent than I used to. In the third quarter, about 2 months ago, actually it was in the early fourth quarter, they had for what was for Apple a pretty abysmal conference call. And among other things, they said, hey guys, we didn't sell as many of the 13s as we suggested that we might sell 2 quarters ago. And among other things, they cited supply chain disruption, but they also cited lack of pre-orders. Now, unlike the 12, which was virtually sold out before it ever hit the shelf because of all of the pre-orders, they didn't have that for the 13. Why? I've got the 12. My income is not keeping up with inflation. I'm feeling that it's harder to live. I'm spending more on gasoline, more on food. Why do I need the 13? The 12's just fine, thank you very much. I don't need your new phone. Apple basically, if you read between the lines, just told us our revenues aren't going to be what you thought they would be 2 quarters ago. Yet the market did not blink and the stock continued to melt up to a new all-time high. I'm not telling you to sell Apple. That's not a recommendation. But I am saying these are the things you need to watch out for. You need to be mindful of. Especially as companies begin to reduce their GDP forecast. What can we see in the industrial metrics? Both the ISM manufacturing and the services, new orders, factory orders, durable goods, retail sales, we just saw it, industrial production. These are the big ticket durable items. That is not a promising trend. And yeah, there was a little bit of a bottoming out here, but look at what's happening here just lately. Here we go again with what seems to be another leg down. And the future, the forward-looking indicators are not supporting the idea that this is going to turn around anytime soon. There's the ISM manufacturing index. Are we still above 50? Sure we are. But for how long? Look at that trend. Are you starting to see some patterns here of a big run-up and a peak and what seems to be a rollover and then declining metrics? This is the velocity of money. So again, in a consumption economy, rising wages, lower taxes, lower inflation, higher confidence, you typically spend more money, therefore the velocity of money is higher. Companies are spending money. Why? Because you're spending money. We need to make more of these things. We see corporate spending. at a faster clip, velocity of money is high. We go through the recession, and then it tried to recover. Boy, the Fed threw a lot of money into this economy. And that made a dent for a while. But look at what's happened here since. Declining velocity of money as your income is not keeping up with inflation, and we see retail sales declining, and we see all of these other economic metrics showing weakness and a rollover. That does not bode well for the future of our economy, and yet the market hasn't blinked. That's what supply chain disruption looks like. Now, I update this graph about every week, and this is supposed to depict where the ships are, and the ones that are waiting to get into port, that are in port, that just left port. And I mentioned earlier containers being in the wrong place. For a period, we went from making cars to ventilators to cars. There are just certain things you can't make from home, right? But when you have a trade imbalance like we do with China, for every $1 worth of stuff that they import from us, we buy $3 worth from them. So again, not a perfect translation, but for every one of our containers on this port, we got 3 of theirs on this port, and normally we're filling them up and sending them back. But then we shut the economy down. Now we got containers in the wrong place. We didn't stop consuming. We stopped building cars, and that created a bullwhip, a whiplash effect that we're seeing right now. But we were sequestered, we worked from home, but now, instead of going to Publix or going to Target or Walmart, we bought things on our phone, we paid for them through PayPal, and we had them delivered with Amazon. But we still bought stuff, right? So when the economy turned back on, and we were meeting all of this consumerism that never really stopped, our inventory depleted. And now we got to replace it twice. And then we got to keep up. So at one point, we had a tremendous amount of demand. We didn't run out of interstate miles. We didn't run out of railroad track. We didn't run out of capacity and logistical supply to move things. We just ordered 3 times as much stuff as we normally do. And when you got containers in the wrong place, then you have to ship empty containers back to China to be filled because we just ordered a bunch of stuff, and that adds to the cost when they come back. We don't have the trucking capacity to move the stuff. We don't have the rail capacity to move this much stuff. It's backing up on the ports. And even if we could move it, we don't have the warehouse capacity to store it. Yes, all of this is base effect inflation. Yes, part of this, a good bit of this, is in that PPI number. But that's the biggest culprit. The M2 money supply is 38% higher than it was in March of 2020. Let this sink in. Almost 40% of all dollars in circulation right now were printed since March of 2020. None of you in this room are even related to people old enough to remember the last time that happened. Because it's never happened. People ask me, David, how will the Fed address this? I don't know, candidly. I don't know what tools that don't exist today that the Fed will dream up later to address a problem that we've never seen before. But I do know this. The Keynesian economists are trying to suggest, hey, just because it exists doesn't mean it's inflationary, and I disagree with that. Going back to Kramer, my Econ 101 teacher, if you make the supply of the thing more plentiful, assuming static demand, the equilibrium price will drop. Pretty simple. The value of a dollar will drop if you had 2 of them on Monday and you print a third on Tuesday. The 2 that existed on Monday are worth less on Tuesday. Period. So Paul Krugman, I'm not picking on Paul, he's just one of the left-leaning Keynesian economists out there. He's the one that's suggesting, well, hey, just because it exists doesn't mean it's inflationary until it hits the economy. All right, Paul, let's run that rabbit. Before we get off this graph, though, I want to draw your attention to this period of time. This was the Great Recession. Everybody remember the Great Recession? September 15th, Lehman fails. And that was kind of the wake-up call for the world when the markets just went haywire. And over the next 30 days, between September the 15th and October the 15th, the Fed dreamed up 10 new spending facilities that had not existed on September the 14th. TARP being one of them. Remember TARP? Troubled Asset Relief Program. Printed a ton of money to keep the banks solvent and the economy running. That was that blip. Look at what they've done here. It dwarfs the Great Recession. The question I have to ask, if you look, this goes back to 1978, the rate by which the M2 money supply grows anyway. If you extrapolate that line out into space, How long does it take for that bubble to normalize back to where that line would have otherwise been? I might not live long enough to see that, and I'm not being facetious. It took 11 years, December 31st, 2019, for the Fed to dry up 20% of what they printed back there. How long does it take for the Fed to reduce this bubble? I don't know, but I'll give you a visual. I have a 20,000-gallon swimming pool in my backyard. Imagine if I had to drain that thing one sponge at a time. That's kind of what the Fed's got in front of it right now. And if it drains that liquidity too quickly, you create a bigger problem than the one you're trying to solve. All right, so this graphic obviously is a little old. The Fed's actions to taper, and they have to taper. We need to taper. We need to get back to normalcy, otherwise we turn into Japan, and we don't want that. So yes, we need to quit printing money, to buy bonds, to go more deeply into debt, and the very action of tapering is causing a sell-off in the Treasury complex. How do I know that? Because 120 days ago, the yield was 1.1%. When I shot this graphic, it was 1.684. Today, it's 1.83. That's a big move in 120 days. So why? What's happening here? Prior to, the Fed was the single largest central purchaser of Treasuries. So if I'm a pension fund manager in May, and that yield is 1.1%, why do I buy that bond if inflation's at 5? Well, because I know I can sell it to the Fed in June and make a profit on that trade. And in November, the Fed said, that trade's coming to an end. And by the end of December, they said, that trade's coming to an end faster than you thought. It is promoting a sell-off now in Treasuries. There's an inverse relationship between price and yield. As prices drop, yields rise. We've gone from 1.1 to 1.8, and it is only getting started. Now, here's the problem. Every product that a bank manufactures starts with the 10-year Treasury yield, and they add a risk premium to it. Whether it's your home loan, HELOC, car loan, personal line of credit, business line of credit. Right now, the Federal Reserve is paying an artificially high, riskless rate of interest to member banks to not lend the money they've spent 2 years printing. But because of their tapering, it's causing the yield to rise, and as the yield rises, lending becomes more lucrative. They're kind of undermining their own efforts to keep that record amount of money from hitting the economy. Imagine what happens if through tapering that yield hits 2.83, 3.25 over the next 18 months. With inflation at 9.7% on the PPI and a record amount of money that we've never seen before hitting the economy at the same time, could we possibly have a hyperinflation situation on our hands? Maybe. What I can suggest to you is, and what I personally believe, is that we will have stubbornly higher inflation for an extended period of time. 5.5%, 6%, possibly higher. Your wages are going to have to do something that they have never done, and that is to increase by 7% or more consistently for a number of years so that net after tax you can just tread water, and we hadn't even talked about gasoline and food yet. So if a recession is simply 2 or more consecutive quarters of negative GDP and consumption is 70% of GDP, and it's very likely that we're going to have a negative capacity to consume for the foreseeable future, I can make you a case, and I hope I'm wrong, but I can make you a case that we could experience a very unique, weird recession. Shallow, pocketed, it won't hit every part of the economy, that lasts for 5 years. It'll be like listening to a busy signal for 5 years. Just one of these annoying, pesky things. We just can't break out of it because the Fed can't unwind the bubble that they printed, and because of tapering, yields are going through the roof. That money is making it into the economy. What is the classic definition of inflation if it's not too many dollars chasing too few goods? At the beginning of this diatribe, we talked about how consumerism is declining and companies aren't making as many of the things that you're not buying anymore. There's your too few goods, and that mountain of money that we just saw is the too many dollars that will be chasing them. Classic definition of inflation. Now we're starting to read articles like this. The Federal Reserve is in deep trouble. We've been saying that for months. Now we're hearing Morgan Stanley CEO, among others, suggesting that the Fed needs to aggressively raise interest rates as they are tapering aggressively, and I hope not. I hope that there's a moderated way that they can approach this, because if they unwind this too quickly, it'll create a larger problem than the one they're trying to solve. Larry Summers, Barack Obama's Treasury Secretary. This was when? This was back October 14th. said the Fed's already lost control of inflation. Yet Janet Yellen is suggesting, the current Treasury Secretary is suggesting, oh no, we got it under control. One of them's wrong. And we've just seen a spate of economic data that seems to suggest it may be Janet Yellen. But yet the market hasn't blinked until lately. If you wanted confirmation, here it is. Social Security announced a 5.9% increase in benefits for starting this year. You wouldn't see that if inflation were transient. It is systemic. All right, so now I'm going to kind of come to the crescendo and the coup de grace here. Why is all of this bothering me? I've been saying this throughout the presentation. The market has not blinked yet, but I believe it's about to. Now, clients here in the room, clients watching, you know we've spent all year trying to anticipate this and being proactive and getting ahead of that. By incrementally, not all at once, but incrementally moving over to the side of the market where valuations made sense. Stocks of companies that make the things that you're going to buy anyway. Said another way, I doubt you're going to consume greater quantities of that designer cup of coffee, but you're still going to buy toilet paper and aspirin and toothpaste and dishwashing detergent and bars of soap. You're still going to heat your house, talk on your phone, and turn on your lights. If you have a headache, you're going to take an aspirin. Pharmaceuticals, utilities, financials, staples, precious and industrial metals, with a sleeve where money's being spent anyway, like infrastructure. Whether the economy collapses or not, the Congress just promulgated $1.2 trillion. That will flow this year into bridges and railroads, the build out of the 5G network, water filtration plants, power grid, so forth. And where are companies spending money? Process automation technology and information management. So we want to avoid nebulous footprints in the highly overly priced sectors, which I believe are the growth sectors right now. And this was current as of the end of the year. And what it depicts is the historical average, the forward price to earnings ratio, which right now is 21.4. The average growth stock is trading at over 45 times earnings, which makes it 2 standard deviations above the mean, 96% above the historical average. The last time we saw this was when the tech bubble burst. I have to be mindful of this stuff. I'm going to show that graph to you in another way. First, let me go back to this. The average value stock is trading at 12 times forward earnings. Citigroup is trading at 8 times forward earnings. Again, that's not a recommendation, just an observation. There are plenty of stocks out there that are trading at valuations that are well below the market's forward PE right now. So that would be your average value stock. That's your average growth stock. By the way, there are a lot of growth stocks out there right now that are trading at 100 times earnings or higher. Now this is the same graph expressed in a different way. This still goes back to 1950, but now I have smoothed it for rolling 10-year periods of time, because after all, the market rises. So now we have a rising average forward PE. We are still plus 2 standard deviations above the norm, above the mean. And we were too back during when the tech bubble burst, but look at relatively, look at where we are. We are in uncharted territory right now in terms of the average growth stock. So again, I have to be mindful of the fact that your capacity to consume is declining sharply. We can already see retail sales down sharply, yet there are some growth stocks out there that have just continued to melt up and have long since fallen off the spreadsheet. That's what we do to see this every month as this data changes to help you guys get ahead of this and into areas of the market where valuations maybe are better. So let me just express it this way. If you are an investor, and I don't care what side of the market you're in, if you're investing, you're taking risk. So as such, we all live on a fault line. In some ways, I kind of feel like the guy that's trying to predict the earthquake. We're going to have an earthquake. I just don't know when. Can't give you the date, can't give you the GPS coordinates. Have an idea of what the magnitude might be. My job is to help you build a house and prepare for it. I can't guarantee you that you won't have to straighten a picture or move a chair, but I'm fairly certain your house won't collapse. Sometimes you can see a market correction coming, and this one's coming like a freight train. We couldn't see the COVID correction coming. Who would have ever thought that a virus would have caused the economy to shut down? But this one I think we can see. This is another graphic. This one will keep you up at night. So it goes, this one I sourced from Mott Capital, and it goes back just a few years, but it's drawing a baseline in terms of support and in terms of a series of lower highs as a forward PE, lower highs from the top of a market right there before COVID. The market keeps trying to break through, and every time it does, it falls back and it establishes a lower high in the cycle, and that's the point where these two things intersect, where strange things might happen. But look at what's happening now. We've broken out above this, and that would be a good sign if we had solid economic metrics. I just showed you a bunch of them that say otherwise. So the growth side of the market is very overly valued right now. The risk to return relationship there is very askew right now. And the good news is that we have spent well over a year getting ahead of this into the dividend-centric side of the value side of the market, where you're still going to buy cheese and toilet paper and bars of soap and dishwashing detergent. And for at least the next 10 months, we need to stay there. The things that we own may change. 10 months from now, something might happen, though. Personally, I believe both houses of Congress will flip. Now, this isn't a political discussion, but it's important to recognize that if that were to happen, we can expect that spending might slow down, too. This Congress is coming back now with, among other things on its agenda, breathing life into the Build Back Better bill again. There is yet another COVID stimulus relief bill that they're going to promulgate, among other things. The Fed, though, has announced that they're tapering. They're printing fewer dollars to buy fewer bonds, yet the Congress seems bent on going more deeply into debt with additional spending. So right now, that is a headwind that could make prices decelerate even faster and yields rise even faster, which incentivizes banks to lend the money to get this money into the economy, so therefore we have higher inflation. If in November we see a flip in the Congress, spending stops, now that's a tailwind. So in January of 2023, our economic outlook might change as a function of that. But for right now, I can see 10 more months worth of interesting periods of time as the market gradually reprices this risk. Big tech growth stocks slammed by rising bond yields. This was last week, by the way. Look how far we've fallen in about a week and a half. No, they're not being slammed by rising bond yields. They're being slammed by the environment that is supporting rising bond yields. Yes, the market does reprice risk, and it's in the process of doing that right now, I believe. Ready to rotate, investors are dropping growth and heading to value for all of the reasons that we just talked about. Problem is that long before you saw this headline on Fox, we were doing it all year long. This, I think all of you have seen this. This is the corporate misery index. And again, I've said this before, it's kind of a misnomer. The corporate misery index is at a low point when you're going through the trough of the pain point. Oops. So think of it this way, it can only get better from here. We were in a dire situation in the trough of the COVID recession, so our ability to outwork last quarter is better than it was prior to. And we saw that. We outperformed that quarter and that quarter and that quarter and that quarter. You saw that on the metrics that I just showed you, but it gets increasingly harder to outwork yesterday, doesn't it? And then when you start to see a rollover in consumption and income and inflation and gas and food, net margins are curiously declining too. Guess what else is rising? The corporate misery index. We are hearing words like worse and harder and bad. When you look at the Twitter algorithms, many more times than you're hearing words like better or improving. I have to be mindful of that for this reason. Right now, this has not peaked. It continues to climb. It is at a higher point than we've seen since 1984. Every time we've ever seen a peak in the corporate misery index, it has been followed by a decline in earnings per share growth. And every time, at least going back as far as 1978 is concerned, every time we have seen this combination, it has also been followed by a correction. Maybe this time is different, but there are a dozen red flags on this flagpole right now. I have to be mindful of those in terms of the advice that I am giving you. Now, there are some bright spots, if you want to think of these as bright spots. Pricewaterhouse and a myriad of other companies. I see a half dozen of these blurbs every week. They are employing people remotely. This is, about 6 months ago, Pricewaterhouse announced that they would employ 40,000 Americans permanently on a remote basis. It's not a COVID thing anymore. It's an economic thing. We'll find out shortly what might happen in terms of the tax code if you're a business, but in terms of consumption, taxes, velocity of money, there are all kinds of reasons why companies are looking at getting leaner, not bigger. Bringing people back to a brick and mortar location is not something that's going to save money. So companies are looking at creative ways to employ people remotely. So process automation technology, information management, we have to have a sleeve in that in our portfolios. Flight. I know the media is still very COVID-centric, but you know what? Looking at what people are doing. They are going to concerts. Have you seen the sold-out football stadiums? I have tried unsuccessfully twice to get tickets to local country artists as they're coming to Birmingham, literally dialing into the website 3 minutes after it went live and they're already sold out. People are consuming leisure as it were a staple because of the time that we spent sequestered thanks to COVID. They're flying too. The corporate business model, face-to-face business model did come back. We can look at the day before Thanksgiving and the day before Christmas. Demand for travel was back to pre-pandemic levels, but the airlines weren't equipped or staffed to handle it. So as long as that imbalance is there, we need to have a sleeve and a strategic holding in those areas. So just wrap up as I'm closing my thoughts. This is a marathon. It's not a sprint. Things change daily. We have to be mindful of those things. And what we are faced with right now does not look very encouraging. And I believe that the market is only now starting to reprice for that risk. But I do think that largely we are on the side of the market where valuations are low and they're compelling. As money rotates from one side to the other, this may be where it goes, but it'll go there because you're in the companies that make the things that you are going to consume anyway, whether the economy is in the tank or not. We've expanded the bond sleeve. We've become very income and dividend centric. So this is what we do when we feel like we're about to come into a period that's challenging. And then on the flip side of the correction, that's when we look for some of these high beta growth stocks that maybe have corrected 30% to pick those up into the portfolio again. We're not there yet. Maybe we're there in 6 months. So this is going to be an active year. And it's going to be a year that is not characterized by autopilot portfolio management. This is very much hands-on at the granular level, monitoring this stuff as it changes daily. Thank you for your attention. I know this is a repeat for a lot of you, but again, the data changes daily, so we need to be mindful of this. At this point, I want to introduce the person y'all really came here to see. I'd like to introduce Monica Quinn. She is a new addition to our professional resource group at Keystone Financial Group. She's a tax attorney with Massey, Stotzer & Nichols, and I will let her continue her introduction. Monica?
Hi. I want to thank David for inviting me to come and speak with y'all. When he asked me to come and speak about upcoming tax changes, I thought there was going to be a lot happening last year. And then the year kept creeping on, and nothing was getting done, and everything, all of a sudden more stuff kept getting cut on what they were going to change, and got to the end of the year and nothing happened. So I think it's important to look at what they were looking at changing to see what might be upcoming in the next couple of years. Politics have a lot to do with it. We're in an election year, and most likely they don't like to get a lot of stuff passed to increase taxes in an election year. So I don't think we will see too much happen this year, which is good. But I think depending on the elections this year, and if we don't have a flip in Congress, we might be seeing it in the next couple of years after this year. So I want to go through and look at the stuff that came up last year. I think there's the clicker. And what was proposed. Really, it started in March. I'm going to go through the main tax proposals that came back down. I think it's important to look at who was sponsoring them, because that also lends to, well, are they likely to be passed? Who's really looking at them, and when, and what kind of gets cut? And I'll do is I'll tell you about the plans, and then as I talk about the changes, I will relate back to which plans we're really focusing on those kinds of changes. So on March 25th, Bernie Sanders came out with the 99.5% Act. A lot of it focused on estate planning changes and estate taxes. On March 29th, some Democratic senators and House representatives co-sponsored the STEP Act. It was the Sensible Taxation and Equity Promotion Act, and it really focused on step up in basis, which I'll discuss. And on May 28th, the Green Book proposal, which is Joe Biden's tax proposals, came out. And it was the general explanations of the administration's fiscal year 2022 revenue proposals. And then on September 13th, the House Ways and Means Committee presented their tax plan. But the House cut a lot of their proposals when they passed the Build Back Better Act. And as we know, the Senate is still potentially going to vote on it, but I think even Biden came out this week and said there's going to be more cuts to that to get it through the Senate, that they don't think they're going to be able to get it through. So I don't think we'll see a lot of changes that will affect a lot of people, but I don't think these concepts and ideas that came out this year are going to go away. I think they just might be stalled for a couple years. So I'm going to go through first the ones that are still left in the Build Back Better Act. Now, some of these have since, Biden, I think this week, came out and even said some of these, the extended child tax credit is probably going to be cut from this before the Senate, it gets to the Senate. But the first one is the net investment income tax expansion. The plan is a 3.8% surtax, and right now it doesn't apply to pass-through businesses, LLCs. And S-corps, and they are wanting to apply it to the S-corps and pass-through businesses. So people that have used S-corps and LLCs to avoid this tax might not be able to do it in the future if this goes through, which really means looking at how, with the LLCs and S-corps, a lot of times you look at distributions versus income on how you take the money from those businesses, and it might need to be reevaluated if this passes. The enhanced child tax credit, I want to be able to give y'all some numbers. So that's the $3,000 per child, or $3,600 per child if under 6. I think this was in David's presentation. This has not been continued as of yet, and Biden, as I said, he came out this week and said he doesn't think he's going to be able to get that through the Senate. So I don't think that will come into play. Basically, the child tax care credit will revert back to the original $2,000. It also proposed a minimum tax on book income. So a lot of people have probably seen articles that Amazon doesn't pay any tax. That would change with the minimum tax on book income. Basically, any corporation with over $1 billion in book income would have a 15% minimum tax. It's not going to affect a lot of smaller businesses. It'll affect about 1,000 businesses, Amazon being the primary example of that. But this might also affect their stock prices and ability to issue dividends if they're subject to this tax. The next one is a surtax on corporate buybacks. Corporate buybacks is where a corporation buys back its own stock. This increases the stock prices when a company does this, and some companies have had aggressive corporate stock buyback. Examples of large companies are Apple, Google, Facebook, Oracle, Microsoft that have been doing this. The bill proposed to charge a 1% surtax for them doing this. So this could slow appreciation on those stocks that we've been seeing. Then the next thing is a high income surtax. This affects people with adjusted gross incomes over $10 million and estates and trusts with income over $200,000. And it would be a 5% surtax on the amount over that income that they're proposing. They would additionally tax additional 3% for anything that exceeded $25 million for individuals and $500,000 for estates and trust. So, as I said, probably not going to affect most Americans, but something to keep an eye on that they're looking to increase. The next thing is the the state and local taxes. So the Tax Cuts and Job Act, which sunsets in 2026, reduced the amount that the deduction individuals could take for state and local income taxes that they've been paying to $10,000. Now it sunsets in 2026, and in 2026 the deduction would be unlimited, but the Build Back Better Act proposed to go ahead and increase the deduction to $80,000 starting next. Well, it was supposed to start this year, so I don't know how they'll change that with the Senate, but and it would last till 2032. And then the 10,000 limit would go back down then to 10,000. So Alabama doesn't tend to have the higher state income and local taxes. The states that would really benefit are people that are living in like California, New York, that have the high state and local taxes. And then they were also proposed changes for IRAs. They were going to limit how much people could put into IRAs for high income earners. So if your income was over $450,000 and you were married, the cap would be $10 million could go into an IRA. So they were going to cap that, which they've not done in the past. So that's the stuff that kind of survived into the actual act that's before the Senate. As I said, Biden's already saying that he doesn't think he can get the extended child tax credit. I would anticipate, even if they can get it, some of these other changes also not passing as well. But this was a really watered down version of what they started with. And the other stuff was, I think, would impact more. So the one thing that a lot of people, and I'm sure everyone heard about this, the capital gains rate increasing. I had several clients ask me about this. And that did not make it into the Build Back Better Act that passed the House, but it was in the House Ways and Means Committee tax plan. So I gave you the examples for what the tax rate is this year, and then what it would have been for the 25%. So a lot of people heard that it was going to increase by 5%. And so really that change applies if the taxable income was over for single filers $459,750. And then for married filing jointly over $517,200. So that's where that 5% came in. So, but that's something to look at. I know that was a big point this year for a lot of people, was the increase in capital gains tax. So I had a lot of people saying, do I need to go ahead and sell this if I have a lot of capital gains stored up in a piece of property? Depends on how much was stored up in the piece of property. But as we've seen with real estate, prices have increased, so it's not uncommon to see a lot of gain in properties. I think in California they've seen a lot, but even here, property prices have increased. And if you have family property that you've had for a very long time, that's been passed down, maybe that's been stored into a corporation or LLC that hasn't had any kind of step up in their basis, there could be a lot of capital gains in some properties, and that it could reach these levels in effect. Another thing that came down in a lot of them was the tax exemptions, the estate tax exemption amount. I do a lot of estate planning and looking at this, and right now and in the past few years, the estate tax exemption has been really high, higher than it's ever been. So in this year, because it did not get reduced, it's at $12,060,000 is the estate tax exemption amount this year. Now, that's the estate tax exemption amount. It's unified with the gift tax. It's a unified amount. So during your life and upon your death, that's the amount that you can give away and not have to pay taxes on. So you can see, and I've given you the numbers from 2001 to now. You can see it's been around $1 million, and right now it's up to 12. What they wanted to do, and the most common thing, there's been different plans, but the House, I'll give you all of them, the different amounts they were wanting to reduce it to. Sorry, find these numbers. There was a lot of different plans. The 99.5% Act, which that's Bernie Sanders. So likelihood of that going through was already kind of probably not as likely, but he wanted to reduce it back to 3.5 million. So that was the first thing that we heard last year. That is a drastic difference from, it was over 11 million last year, 12 million this year, 3.5. That's going to affect a lot more people. So it also wanted to reduce the gift tax to 1 million per person. That means that he wanted to restrict your ability to give away stuff during your lifetime, so that way on death you have more assets, more likely to be taxed. He also wanted to reduce the annual gift tax exclusion amount. Last year it was $15,000. It was $15,000 for a few years. This year it's at $16,000. He wanted to reduce it to $10,000. So one way that if people are going to be over that estate tax exemption amount is they give it away before they die. Now there's limits to that, because if you give over a certain amount, it eats into that exemption amount. But one easy way was to go ahead and every year give each of your kids $15,000. It reduces it some. And not only you can do it, your spouse could give them that amount too. So together, you could give them $30,000, and this year it'll be $32,000, and not have to worry about any kind of gift or estate tax issue or implications. Now he wanted to restrict that to $10,000. He wanted to even further restrict it to say that it's $10,000 per person, but you can only do $20,000 total among everyone that you give the gifts to. As I said in my example, you could give $10,000 to each of your kids. You could give it, $10,000 to John, $10,000 to Susie, $10,000 to Mary. And $15,000, but in his 10. But in his, he would only allow $20,000 total. So that would drastically restrict your ability to kind of deplete your estate before, to avoid the estate tax amounts. His was the most restrictive. He also wanted to increase the estate tax rate to 65%, the top estate tax rate. And I'll give you an idea on historically kind of where the top estate tax, it's tiered just like income taxes. So anything that you're above that the exemption amount, whether it's 12 million or if it gets reduced, there's certain amounts, but the top rate, it's been as high as 55%. Right now, you're looking at 45%, but he wanted to make the tax rate 65%. Now if it was like $1 billion over, but it was a more drastic scale. So I'm going to give you, now his wasn't the only one. The House Ways and Means Committee also was going to reduce, their plan also proposed to reduce the estate exemption amount, basically back to $5 million. Now with inflation, it's indexed for inflation, it would have been around $6.2 million. I will tell you that we always keep an eye out for the future. It is going to go, if Congress does nothing, it is going to drop back down to that $5 million mark in 2026, unless something's passed. It was part of, it's got a sunset provision on it, and it's going to drop down. As I said, that's about 6.2. Now, that amount is for each person. So if you're married, your wife can give away that amount, and you can give away that amount. But there's planning involved in that to make sure that you can utilize both people's exemption amounts. So it is something to look at, because lately, most people, as I said, they haven't had to worry about it. It's been so high that it hasn't been a concern for most people, but that's not going to last. And with inflation and everything else, I'm expecting that that more people are going to have to look at those numbers. So right now, the estate tax is only affecting, I think it was 0.2% of all estate tax returns filed. Historically, it usually affects at least 1 to 2%. So, and with all the spending, the more spending we do, the more taxes they need to pay for it. And this is an easy one to target. So there's different ways that people try to reduce their taxable estate. I mentioned one, giving away some during their lifetime using that annual exclusion amount. There's 2 other ways that with estate planning that we try to reduce the taxable estate to avoid some of those estate taxes. And one is a valuation discount and for non-business assets. So there's ways that you can form, you might have heard of family LLCs or family partnerships, where you stick money in these LLCs and partnerships, and then you give away some of it to your kids, and they don't have any voting rights. They might not have any say in the money. When you do distributions, they get some of it, but you've given it away to them. But because they don't have a right on how the money is distributed and how it's invested, it's not as valuable to them as the actual amount. So you can say you put $10 million in a family LLC, and you give a kid 10% of it. So they get basically $1 million. But because they don't have a say in how it's used, you can hold it in that LLC, and they don't have any right to the distributions. The IRS allows us currently to discount that, and it could be an 80% discount. So even though it's stocks and you've given it away to them for estate and gift tax purposes, you really only gave them, instead of $1 million, you really only gave them $800,000, but you got $1 million out of your estate. That was one of the things that the House Ways and Means Committee wanted to get rid of, the ability to use that kind of technique to reduce your estate tax. Another one is elimination of grantor trust benefits. Another technique we use is to create a trust and put assets into a trust for the benefit of the children or the beneficiaries, whoever it might be. You put them inside of it, but the parent still pays all the income tax on it, even though it's a completed gift. So it's like an additional gift to the kid each year that you're paying the income taxes that they would otherwise have to pay. And it doesn't count as a gift for IRS purposes. That was another thing that I think the House Ways Committee did it, and let me make sure. And the 99.5% Act also wanted to get rid of. So these are concepts and ways and techniques that we've been using to help reduce estate taxes, and they've got their eye on getting rid of them. So this was a big one, and the one that was most concerning to me was basically recognition events upon certain events. So right now, when someone dies, if they inherit a piece of property, you don't have to pay capital gains tax on that when they inherit it. You actually get a benefit. You get what we call step up in basis. And what that means, and this is going to be my example, so say you had a piece of property and it's worth $400,000, but you bought it for $200,000. So there's $200,000 worth of potential gain. So if you sold it today, you would have a $200,000 gain in the property that could be taxed. And now there's all kinds of other things that go into it. So this is a very basic example on this. And say you gave it to your children instead. They get the same basis you had to it in the property if you give it to them. So they will have that same type of gain. Now say you buy the piece of property, instead they inherit the property at your death. They get that same piece of property. They get to increase their basis to the value of the property at your date of death. So there's no gain if they sell it after you die. So the Green Book plan, so Biden's plan, and also the STEP Act wanted to eliminate this. They wanted to say, instead of a step up in basis, not only are we going to do that, even if the kids don't sell it, they still need to pay us the $200,000 worth of gain that's in that property when you die, even without selling it. So we had two different acts come down, two different proposals, tax proposals, that wanted to do this. So this is concerning. Now they did have provisions in there that it would be $1 million could be transferred without having this gain, up to $1 million in basis. But as I said, if people hold on to property their whole life, typically there could be a lot of gain in property, mostly commercial property. I often see that even with residential stuff where they buy stuff, especially if they buy it in California. A lot of people retire here from California. I had someone recently, and they had about $400,000 worth of built-in capital gains in the house they sold. And it wasn't their primary residence any longer when they sold it, because they had moved to Alabama. So timing is everything. Probably should have sold it while I was still in California, but there was other things that they could get around and work with a little bit. But but that makes a difference, a huge difference potentially with people. So I think it was just the STEP Act. Bernie Sanders might have said it too. I'm trying to make sure. No, just the STEP Act and the Green Book proposal. So that's the one I was keeping my eye on the most last year, and I think it's one to keep an eye out for in the future, because a lot of people do hold on to property that has a lot of capital gain in it, so that when they pass, their kids get that step up in basis. Strategically, it's something we look at when planning. So I would say that's the biggest one to keep an eye out on. So. Does anyone have any questions?
I got a question.
Mm-hmm.
So what about people that have deep basis positions in stocks that they give to their church or a 501c3?
That wouldn't be included.
That would not touch that.
Yeah, sorry. Spouses and charities would have been excluded under these tax proposals. Okay. So that is another way that people do get rid of assets that have a lot of gain in it. That's an attractive asset. Instead of giving them cash, let me give them something that's got a lot of capital gains in it. If you're going to give to charities anyways, it's a perfect place to avoid that gain, is to give it to churches.
If there's a $200,000 basis, the market value is $400,000. They get to deduct the market value of the stock And then the recipient, the church or the 501c3, pays no tax on the liquidation of the asset.
Right, correct. And same thing if they, even if they don't donate it when they're alive, if when they're deceased, anything that you give to charities when you're deceased does not count towards your exemption amount. So it's an attractive asset to list to a charity. Instead of listing a specific dollar amount, maybe list an asset. Maybe give them some dollar amounts too, but try to unload those ones with a lot of unrecognized gain. So that would be one option to do to try to avoid this if this type of thing passed. And definitely something I would advise doing if something like this passed. Fun topic of taxes.
This is just more of an interesting question relative to the IRS itself. You know, you hear these stories on the news about how far behind they are and, you know, doing, you know, returns, and I mean, and it sounds like they're just getting farther and farther behind, and
they are understaffed.
Screaming and hollering about needing more money and more help. And
yes.
Do you see that as a major issue, or just getting worse? Or I'm just curious
yes.
what you know about it.
Well, I will say I got my LLM in taxation. I was in 2010, and they were screaming that then. They would come and speak to us about that. They have been understaffed for a very long time, and part of the reason they don't have the staff is not necessarily that they've had a decrease in staff. It's because a lot of more government social programs are put through the tax code. Instead of creating a social welfare program, they do stuff like earned income tax credit. That's really for people, to help people that are low income, and instead of creating a welfare program, they stick it through the tax code. Well, the IRS is the one that has to deal with that. They're the ones that have to audit it. They're the ones that have to monitor it. They don't have the resources. They don't really have the resources to audit like they need to and stuff. So, I mean, I will say I've seen a lot of stuff through my career. I've seen some taxes that they don't catch, that they're filing wrong. And more on a lower scale. The higher income people they're looking at more than the low ones. And I've even taught the assistant U.S. district attorney, and I saw a lot of tax returns where people that are actually married will file head of household and single. It's not allowed. I mean, that's not how you should do it, but they get better refunds that way. And I asked them, you know, why don't y'all really pursue that stuff? It's not worth it to them. They will spend more money going after it than they make, and they don't have the resources to do it. And that's just what they told me. And that's a flat out, we don't have it, we don't have the resources. And so it's not a recent problem with the IRS not having the resources and the staff. I mean, that was happening before 2010.
Oh, yeah.
So I think it's a problem that's going to get worse and worse, because I think government likes the idea, because it's cheap to just do an earned income tax credit, a lot cheaper than creating a welfare program that you have to have employees. So it's a great concept for them. It's easier to pass, it's easier to get it up and going, but they're not giving the IRS any more resources to deal with it. And it'll just get worse, in my opinion. So, any other questions?
Best guess on the likelihood of massive tax reform this year?
Not likely. Not if they want to get reelected. I mean, and that's just historically, and I will agree too that historically in midterm elections, the Congress flips. I mean, the Senate's gonna, so if you look at historically, what will probably happen is nothing will happen probably this year with tax reform, or very little. Next year, same thing. 2023, probably not much. 2024, we might see it. And with government spending, you have to raise the money somehow, whether you print it or you raise taxes. Those are their two options. There's no other way that they make money. So they're going to have to do something. I mean, they definitely already passed $1 trillion that they're going to spend. So And if they pass any more spending, it's got to be paid for somehow. So, and estate taxes have been one of those that it's a popular one to look at. Some people look at it as it doesn't harm anyone a little bit. I've seen that kind of attitude in persons deceased, but the heirs probably feel differently. And you don't want to work your whole life just for the government to take it when it's over. So there's techniques to go around it, and even they're trying to catch a few of those. As I mentioned, the valuation discounts with businesses, and that's only with that doesn't apply to active businesses. I guess I should say that too. That's more where you put in non-passive assets into a business that they're wanting to catch. Real property is a popular one to stick in, and stocks, financial stocks and stuff. That's what they're trying to catch. They're not trying to catch people with small businesses that get valuation discounts, at least not yet. So I will say the biggest proponents against decreasing the estate tax exemption amounts are typically small businesses and farmers. The lobbyists, farmers pay for a lot of lobbyists to fight against this kind of stuff because they're the ones that could be hurt a lot with these kind of passes, especially with losing that step up in basis. I think that would greatly harm farmers. So they're fighting it.
Monica, thank you.
Thank you for
your
inviting
time
me.
and providing all of this information. And folks, thanks for coming. Again, weather, COVID, and all these other things. We had many more that had committed to come, and we, for those of you watching, we wish you could have been here. We hope you found this information to be helpful and beneficial, though. Please feel free to reach out to myself, to Monica. We have plenty of other members of our resource team here. Kelly Daniels, who is in the audience tonight, she is also a CPA resource in our professional resource group. But we are here to help you find solutions and work together as a team as we help you to achieve the goals that we're planning to achieve over time. So again, thanks for coming, and we will be in touch again soon. Stay healthy, stay safe, stay dry.